Unless you're an Adobe shareholder, today looks like a relatively positive one for those in the S&P 500. Now, we have mentioned before that September is historically one of the worst months for US stocks. In fact, we can see since 1945, the monthly average is around negative 0.73%. And when we take this a step further, for those that have read our latest weekly article, we do talk about how, in fact, the S&P 500 also underperforms in the US presidential elections. As we can see from the data we have, the last 6 elections, it has averaged a negative 4.3% return. Now, based on that information, what we thought we'd take a look at today are 10 stocks that we can see from this article just a few days ago that will have some massive gains. This is whether or not the Democrats or the Republicans win in the November election. Now, we're going to take a look at just a select few, although we will show you all 10 so you can clearly see which ones they're relating to. Now, we have 5 for the Republicans, that is Tractor Supply, Goldman Sachs, Tesla, Apple, AT&T. And then for the Democrats, we have 5, which is Five Below, KKR, Sunrun, AppLovin, and Comcast. Now, today we're going to run through just a few of these, see whether or not we agree right now is a great time to get into these companies. Now, the first one we are going to draw your attention to, it is the communications giant AT&T, and this one has been soaring up 50% just over the last 12 months, and we can see right now trading at its 52-week high. We get a double buy rating from Seeking Alpha and Wall Street, we get a hold from Quant, and we can see it is trading at a forward P just under 10 with a yield of around 5.14%. Now, if you've been a longer term shareholder, you can see in fact you would be down 39%. So although very good gains over the last 12 months, over the longer term, not a very great investment. Nonetheless, though, depending at which point you bought, this could be one that you could be up significantly, especially over the last 12 months. Now, in terms of their earnings, how have they reported over the last few quarters? Well, more recent quarter, Q2, it was in line. They did beat in Q1, and we can see they missed previously. So out of the last 4 quarters, we have a 75% positive track record of at least being in line or a marginal beat. Over the next 2 quarters, though, they are anticipating decreases to the EPS year on year. But nonetheless, if they do hit that EPS estimate for December 25, the forward P will come down, although marginally, to 9.54. Now, we'll very briefly look at their dividend safety. For AT&T, we do see a 60 borderline safe score, and one thing we do want to highlight on this channel is that they haven't increased their dividend for a couple of years. Longer term shareholders will be aware that they did have a dividend cut not too long ago. Now, in terms of looking at the valuation of AT&T, we'll do this for each one today. Typically, we run through each one of these models, run through how we got to them. We won't do that today, but we'll just show you their 4 different models and the average of these that we have used, giving intrinsic value of $22. Now, we also note Wall Street see around that price over the next 12 months, so very minimal gain of around 2%, but this could be one to consider if you are looking in to locking a fairly high yield of around 5 to 5.5%. Again, though, when we do take a look at it in terms of the margin of safety, we ideally like to start with a minimum of 10%, which we execute on if it meets our 3 golden criteria. That is a wide moat, strong financial metrics, and good forward-looking data. We can clearly see AT&T isn't there yet. You need to wait around $20. At the 15% point, around 19. At 20%, around 18. And 25% around 16.6. Now, as we mentioned, right now you wouldn't even be getting a 5% MOS, so we do see this trading pretty much around its intrinsic value, and for us, this isn't one we would add to. We would need a very nice MOS level. Companies like AT&T also take on a significant amount of debt, which is why we did see that dividend safety score at borderline safe. As always, we're going to run through these. Do give us your thoughts in the comments below. Before we move on, just to let you know, we have released our latest weekly article. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below, where you can start to read straight away. And we also want to make you aware we have released our 25 undervalued stocks for your consideration in the month of September, where we also talk about each one that sits within our own portfolio as well. So do check that out by clicking below. Moving on to the next stock, we have Tesla, where we actually get a triple hold right across all 3 analysts. This one is trading in the mid to upper end of the 52-week range. forward P around 97, and we can see over the last 12 months it is down 15%, although if you've been a shareholder over the last 10 years, you would be up more than 1,220%, significantly outperforming the S&P. Now, in terms of their earnings, not a great sign. Over each quarter over the last year, they have in fact missed, so a 0% track record, and we do note over the subsequent two, they are anticipating a decrease to the year-on-year earnings per share. Again, if they do meet that December 2025 target, the forward PE will come down to around 72.04, and given they don't currently pay a dividend, we are going to jump straight into the valuation. Now, in today's episode, we have a price of $179, which is significantly lower than the current trading price, although we do also note Wall Street, whilst it is higher than our value, do see a price lower than the 231 we see today. Therefore, they believe over the next 12 months, Tesla will go down around 8% to 211. So how did we get to this 179? We'll just show you for Tesla, as we've just used the one model. We have the DCF model, the free cash flow year on year. Now, average growth fairly skewed given the changes year on year from negative to positive, but ultimately we've gone for three different growth rates: a low, medium and high, 25, 30, 35. We've gone for the middle one today at 30%. With a discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we have here, ultimately giving us downside of 23%. Now, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Tesla or any other company. And just for transparency, we'll show you that 25% does give a value of $130, downside of negative 44%. And for those that believe 35 is more accurate, more representative, we do see that 244 ultimately very marginal upside of 6%. Nonetheless, at the 30%, we are ultimately saying there is 0% upside. And for those just want a very quick look, we'll at 10% a buy at 161, at 15% around 151, and at that 20% level 143. Although in conclusion for Tesla, we do believe you are paying a premium, with Wall Street indicating downside of around 8%. The next one that we have is Apple. Now, we just get one buy rating from Wall Street, with both Seeking Alpha and Quant giving this company a hold. This one is trading at the upper end of the 52-week range, a fairly trivial yield, 0.45%, and a forward PE of 33. For those that want to know, S&P around 23.5. Over the last 12 months, we're up around 27%. Over the last 10 years, again, another one that has significantly outperformed the S&P, up 785%. Nice to report they have outperformed analyst targets over the last 4 quarters, 100% track record, with the subsequent 4 indicating nice growth to the earnings per share. As we can see, September 25, they anticipate that earnings per share, which will bring the forward P down to around 30.05. Also nice to report a very safe dividend score, 99, highest score obtainable, although a little bit disappointing. They only increased that dividend by 4.2% this May, which is pretty much bang in line with the average inflation rate over the last 40 years. In terms of our valuation, well, we have our intrinsic value of $208. Again, similar to Tesla, we do believe right now it is trading at a premium, which is indicated with the current price being higher than this value. Although we do note, unlike with Tesla, Wall Street believe the price is both higher than our value as well as the current price. They have a target of 250 with upside of 12%. And again, we can quickly show you for this DCF model, we've gone from a 10% growth rate moving forwards, which we've actually gone for the lower rate of the 10, 12, 14, because it is in line with the average over the last 10 years. Now, based on this, if you were looking for a 10% margin of safety, a buy at $187, at 15% a buy at $177, and at the 20% mark at $167. So today's episode for Apple, no margin of safety, a fairly hefty premium with a small upside from Wall Street of around 12% over the next year. We then move on to Comcast, where we have a double buy rating and a hold from Quant. This one trades towards the lower end of the 52-week range, a yield of 3.15% and a forward P of 9.4, down 12% over the last year. Over the last 10 years, up around 40%, not great over a 10-year period. And we also see all-time highs sitting around $62, and we are talking now around 3 years ago. In terms of earnings, very similar to Apple, they did outperform over the last 4 quarters, 100% track record, although unlike Apple, they are anticipating 1 quarter of negative EPS, subsequent 3 as we can see positive. bringing their forward P down to around 8.96 in December 2025. In terms of dividend safety, again, nice to see a very safe score and actually a fairly decent, strong dividend growth this year, 6.9% as we can clearly see. Then we get to the valuation, well, $52, a little bit higher than Wall Street, although their $48 does bring 20% upside. And when we look at it in terms of a margin of safety, we do get a fairly nice one. 10%, well, $47 buy target, 15%, $44, and then we keep going till it's near the current trading price. Today's episode not quite at the 25%, sitting somewhere between the 20 to 25 MOS, with Wall Street, as we mentioned, nice upside, price target $48 with that 20%. We then move on to KKR, where we have a double buy rating and a hold from Quant. This one is trading at the upper end of the 52-week range, a forward yield of 0.58% with a forward P sitting just below 26. Over the last year, massive growth, up 92%. Over the last 10 years, again, another outperform of the S&P, up 439%. Then we look at their earnings, very positive to report, 100 track record over the last year and strong double-digit growth moving forwards over the next 4 quarters, bringing their forward P down to around 19.81 if they can hit those targets moving forwards. When we do take a look, dividend safety score does look to be borderline safe, something to consider, sitting around 60. And as always, if you want any deeper dives on these companies, do give us your thoughts below. We can see not too long ago, they did increase that dividend by around 6.1%. When we take a look at their intrinsic value, well, $139, pretty much spot on with what Wall Street see over the next year. They see upside of 14%. And when we look at MOS, well, 10% a buy at 125, pretty much around where it is. So you are getting at least a 10% margin of safety. For 15%, you need to wait to around 119, at 20% around 112, and at the 25 percentage point, $105. So today's episode, 10% MOS for KKR, with Wall Street upside indicating 14% over the next 12 months. Do let us know if you are adding to any of these so far. We then move on to 5 below, where we have a buy signal from Wall Street, a strong sell from Quant with a hold from Seeking Alpha. Again, similar to the previous company, trading towards its 52-week lows with a forward P sitting around 20.3. Now, over the last 12 months, down around 40%, and if you look at this over the last 10 years, even though it hasn't had the more recent good performance, still up around 129%, although we can see all-time highs sitting around the $214 mark. Then we talk about their earnings. Again, not great, especially if this is one you have followed over the more recent quarters. Whilst being in line in quarter 2, the previous 2 quarters they have missed, and moving forwards they are anticipating some double-digit decreases to the earnings per share. However, for the next full year, they are anticipating a marginal increase to $4.99, bringing that forward P to 18.5. Again, no dividend currently, therefore we'll jump straight into the valuation. $103 as the intrinsic value. Wall Street $97, so only 1% upside. They believe it's trading around its fair value, and we believe also the same, because when we do put it through the MOS calculation, not at a 10% MOS just yet, at the 5% around $98. So for 5, we do get a 5% MOS with 1% upside, although there will be some people that maybe do like this stock, and do give us your thoughts below. As always, if you've enjoyed the content, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of the videos as they drop. And don't forget to sign up to the free weekly newsletter below, and also come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.